Afternoon, everyone. Almost, yes, it is afternoon officially. Thank you for joining us today. We're delighted to have you. I hope you'll find this program very informative and helpful to you as you barrel toward year end. I have a few housekeeping items. My name is Sharon Capetta. I'm the Director of Development here at the Community Foundation. And I think everyone's used to the webinar format. If you have questions, please use the Q&A feature and you can submit them to the panel. We will try to leave some time at the end for questions. And if there's something that is burning, Rick has graciously offered to take them as they come. Our speaker today is a colleague and pleased to say friend, Rick Peck. And I've asked Rick if he would do his kind of introduce himself because as you see, has a lot of designations after his name. But Rick has been a colleague, and he and I have the pleasure of serving on the board of advisors in philanthropy with Rick. And I don't think we could have asked for a better speaker to explain the changes in the landscape and the tax and charitable giving implications of them. So without further ado, Rick Peck.
Hello, thank you very much. Can you all hear me? There we go. Here I am. All right, well, thank you very much, Sharon. So I am Rick Peck, and it's a pleasure to be here. I appreciate everyone registering. I can see the participants are now at about 80 total. It looks to be a very hot topic. Well, I'm happy to be that person to come and talk about that. And so I'm going to share my screen right now, and then I'll put it into slideshow mode. And I'll just explain a little bit about myself and my background, and then we'll move into the bulk of the presentation. And as Sharon said, I'm happy to take questions as we go, but also try to be cognizant of time so that we're not too slow in what we're doing here. Whoops. All right, let's get it into slideshow mode. And maybe Sharon, you could tell me if it looks like it's in full slideshow mode.
You're good.
All right, great. All right, so that's me right there, and it's called The Big Beautiful Benefits to Planning Ahead, Charitable Giving, and the Changing Tax Laws. I am a CFP, so I'm a certified financial planner. I'm also a chartered financial consultant, which means I came from the world of financial planning, and so I'm very proud of that. I did that for 7 years, but I've been in the world of charitable giving for 20 years now, as of September 2025. And I worked at Dartmouth College in planned giving. I also worked at Dartmouth Hitchcock Medical Center, which is a local hospital. And I was doing planned giving. I did major gifts. I did principal giving. And then in 2017, I became the VP for Development and Philanthropy Services at the New Hampshire Charitable Foundation, which is how I met Sharon. And also, again, as Sharon mentioned, I was the president of the International Association of Advisors in Philanthropy. So we knew each other both ways. And so I did that for 6 years. And then about 2.5 years ago, I went into private practice for myself, helping to educate nonprofits on how to fundraise better, helping donors to give away money in a more informed way, and helping professional advisors like CPAs, wealth advisors, trust and estates attorneys to do their best work as it relates to having the philanthropic conversation. 2 more designations, certifications I'll mention, the CAP right there, Chartered Advisor in Philanthropy through the American College of Financial Services. And I also have a 4th one that I got within the past year called the Impact Philanthropy Advisor certification, and that's through Daylight Advisors. So 2 financial designations or certifications and 2 charitable giving oriented, and I feel like that's a good balance for me. There's my phone number if you ever need it, 603-387-3897, and then my email, thephilanthropyguy@gmail.com. I also have an website, which is www.thephilanthropyguy.com if you ever need to get in touch with me. But with no further ado, we will move into the agenda. So we have the agenda in 3 parts today. Part 1 is the impacts on charitable giving due to the 2024 election, and what I'm going to hover on are executive orders, just to set the stage for how the year started. just to kind of talk about that in some detail, because that is always enlightening. And also, if you're a nonprofit, it might have made you shiver in your boots, especially in the first week of the year. But what you signed up for today mostly is part 2. So that's going to talk about things like the dollar threshold updates related to the gift tax exclusion, cash and cash deductibility, also talking about annual gift exclusions, just kind of some table setting, and then the qualified charitable distributions. But then, of course, the OBBBA updates, also known as HR1. So the One Big Beautiful Bill Act, or again, HR1, as some would call it. And then the third, part 3, donor advised funds, 2023 trends and numbers. So we're about to get an update from the National Philanthropic Trust. It's about this time of year that they do their update, but I will look at the 2023 numbers just to set a little context for how donor advised funds work. So you're getting kind of a 3-for-1 today, and hopefully you'll get a lot of bang out of this. All right, let's start with 2025. At the beginning, the first quarter, it was a busy first quarter for President Trump. And this is all from a report in January from the National Council of Nonprofits. It was a really helpful resource at a time where things were a little crazy for nonprofits. It was hard to figure out what was happening next. So right after his January 20th inauguration, he signed dozens of executive orders, also known as EOs, through this presentation, covering a broad range of issues, including diversity, equity, and inclusion programs, government grants and contracts, civic engagement, immigration, and certain nonprofit subsectors. Now, some of these executive orders won't take effect immediately, didn't take effect immediately, and many are and expected to be immediately challenged in court, right? So a lot of people don't necessarily realize that just because it was created doesn't necessarily mean it's happening in full force. It means that it still might be challenged in some way. So there's that. But I thought we'd spend a little time on that because some of these executive orders may affect nonprofits directly or indirectly. So it's just, again, good table setting, I think, for what nonprofits are dealing with. So National Council of Nonprofits report, here we go. We're going to go through a series of slides related to various executive orders. And we'll start with this one. The executive order titled Ending Illegal Discrimination and Restoring Merit-Based Opportunity. That was the executive order. And you'll see with each slide, I'll talk about the nonprofit impact. So in this situation, the federal government DEI programs and trainings often provided by or in partnership with nonprofits will be eliminated. That doesn't come as a surprise to most of you, because you'll see how many have unfortunately started to take that language out of their materials. So any nonprofit who has a federal grant related to any DEI work was sent word to cease all DEI activities related to federal awards effective immediately. So again, that's what I said, that fallout from that. All that work that was being done in DEI was basically just falling apart at that point because of this executive order. Another, initial rescissions of harmful executive orders and actions, a very interesting title, right? Nonprofits partnering with federal government agencies or receiving federal funding may experience longer wait times and slower processing, loss of points of contact or difficulty reaching them, and increased strain on relationships. Nonprofits should advocate for and talk to government partners about government grants and contracting reform, and provide specific examples of how processes and reporting requirements could be streamlined. So again, each one has its own fallout, let's say. Each one has its own follow-through. Nonprofits will no longer have direct White House connections through the Office of Faith-Based and Neighborhood Partnerships. So again, this is where nonprofits are getting nervous almost immediately. Another executive order, protecting the American people against invasion, also coupled with protecting the meaning and value of American citizenship, a separate executive order. In this one, nonprofits working with immigrant populations, providing legal assistance or training, or delivering humanitarian or other direct aid may see the need for services increase, may lose funding, and could be targeted by law enforcement. Human services and social services could also be targeted. Another, or actually, this is a callback to one I just mentioned, initial rescissions of harmful executive orders and actions. Also a new one, defending women from gender ideology extremism and restoring biological truth to the federal government. This is a very interesting titles, right? Charitable nonprofits serving LGBTQ plus communities and providing gender affirming care and other services may experience loss of federal funding, increase in demand for services, and strained relationships with government partners. So again, no good news here. And then a callback again to that same executive order, initial rescissions of harmful executive orders and actions, coupled with another one called Unleashing American Energy. Nonprofits receiving or expecting funding from elective pay, also known as direct pay, the Inflation Reduction Act, or other Infrastructure Investment and Jobs Act programs may have the programs and funds terminated. You might see a trend here. And now I'll take a pause. There was a lot of bad news. So I'm just going to stop there. But I just wanted to, again, paint the picture of sort of how the year started and then how this leads into now the OBBBA impact on giving. So the One Big Beautiful Bill Act, again known as HR 1. And a lot of this is pulled from Fidelity Charitable. I thought they did a nice job with how they laid it out to be clear around its effects on charitable giving. So here we go. So it was signed into law on July 4th, 2025, and it begins affecting the 2025 and 2026 tax years. It preserves the Tax Cuts and Jobs Act of 2017. It preserves its basic structure, but it also introduces several new tax provisions, so which is important, right? Now, this is an important part, especially at this time of year. As we record this, it's November 18th, 2025. The OBBBA's tax provisions make 2025 a strategic year for charitable giving. Donors may want to accelerate contributions before certain deductions are reduced in 2026. So again, next 6 weeks can be critical for a lot of you who are working with donors who are trying to figure out what to do. And here we go. So the new OBBBA tax provisions that affect giving. Now let's start with this. Above the line deduction for non-itemizers. There was something, before we get into this, you might remember, and I'm not going to name the amount, but back to 5 years ago during COVID, there was also an amount that could be itemized for non-itemizers as it relates to charitable giving. I'm not going to mention that amount because I don't want to confuse us, but now, starting in 2026, taxpayers who don't itemize can deduct up to $1,000 if you're single, or $2,000 if you're filing a joint return for cash gifts to public charities. Now, with only about 10% of households currently itemizing, which might surprise a lot of you, this new deduction is intended to broaden charitable participation. Now, this amount is not tied to inflation and is unavailable for gifts to donor advised funds or private foundations. I will talk about donor advised funds in a little bit, but just be really clear, not available for donor advised funds or private foundations. Now, another thing, a cap on high bracket deductions. So the OBBBA limits charitable deductions to a 35% benefit, even for taxpayers in the 37% bracket, which is a little confusing. But it's a good thing to remember. Caps at 35%. Effective 2026, high-income donors may accelerate gifts into 2025 to avoid this cap. So that's something that is important, right? Again, what can you do? Because this is, again, it's effective for 2026. So you want to be able to accelerate these gifts to avoid this if you can in the next 6 weeks. And last but not least, on this slide at least, there's a floor for itemizers and corporations. So from 2026 on, individuals can deduct only the portion of charitable gifts that exceed 0.5% of AGI, adjusted gross income. And corporations can only deduct amounts above 1% of taxable income. So just hover on that slide for a little bit, just kind of take that in. There's a lot there. And moving on. So I want to just talk a little bit about the Great Wealth Transfer, which is related, as you might think, in many ways here. And so the post-2025 tax code will reverberate throughout what started as an $80 billion intergenerational transfer. Some would say it's $120 billion, maybe $124 billion intergenerational great wealth transfer over the next 20 years. There's a lot of focus on this, and I'm sure this isn't the first time you've heard about the great wealth transfer, but it's worth mentioning again because so much money is going to be transferred over the next 20 years. How will that wealth be taxed, right? How large will incentives to give it away be? What does the great wealth transfer asset pool look like? That's very important. I hover on that all the time. Oops, sorry about that. Hopefully you can still see that. Can you see? I'm sorry, I might have just accidentally done something here.
Yeah,
Can you see the full screen?
No, Rick, this is Carmen. It went back to the presentation, but
Okay,
not
I'm
the
going to go
full
back
screen.
to, okay, tell me if you can see the full screen now.
Yes.
Okay, great. Back to the same slide. Thank you. Sorry about that. Hit the wrong button. So what does the Great Wealth Transfer Asset Pool look like? And also, what types of giving vehicles lend themselves to the Great Wealth Transfer? So I spent a lot of time on that asset pool. What are we talking about? Real estate? Are we talking about retirement plans? Are we talking about equity in terms of like privately held securities, publicly traded securities, tangible personal property, cryptocurrency, cash? What does that great wealth transfer asset pool look like? And again, what types of giving vehicles lend themselves to great wealth transfer? There's all kinds of different things: charitable remainder trusts, charitable lead trusts, charitable annuity trusts, donor advised funds, right? There's a lot of conversation that can be had related to this transfer and how giving can be affected. And what generations, of course, will be transferring. And now I can say right off the top of my head, and I'm sure you can too, we're talking about the majority here being silent generation, so the oldest people in the country, sort of pre-1946, and then the baby boomers, 1946 to 1964. Those will be, majority of the money will be there. And then, of course, then we're starting to move into Gen X and so on. But I'd say probably those first two generations are where you're going to see most of that wealth transfer coming from. So dollar threshold updates. I just wanted to give you this as, again, part of level setting here. Related to, we want to just talk a little bit about cash and non-cash gift deductibility. So deductions for contributions of non-cash long-term capital gain property, like appreciated securities, which I was just mentioning, but they're held for more than 1 year, are limited to 30% of AGI. That's not new news, but it's just something to note. Now, this is a little bit new. I noticed that some publications are still getting this number wrong, but qualified charitable distributions, $108,000 is the amount for this year that people can take from their IRA, from their individual retirement account, and move it directly over to charity without it touching their taxable income, up to $108,000 per person from IRAs. So you can say $216,000 from a married couple. Now, up to $54,000 can be used to make a one-time donation to a charitable remainder trust or a charitable gift annuity. This is not an insignificant thing. Before, there was no money that could come from a QCD to go toward a CRT or a CGA. And some would say, well, $54,000, that's nothing to write home about. Well, look at it as a foot in the door. It's probably going to go up over time, but right now you can take up to $54,000 one time and create a charitable remainder trust or a charitable gift annuity. You would not get a tax deduction for doing this. You do not get a tax deduction for the qualified charitable distribution going over to charity, but you do allow the charity to receive money. And in the case of the CRT or the CGA, you would receive income from that. And it would all be taxed as ordinary income. There would be no tax deduction. There would be no other type of tax incentive there, but it would be income if people wanted that. A little bit more here. So extensions of existing 2017 Tax Cuts and Jobs Act. Here's a little bit more. So the following provisions from the TCJA were made permanent or extended under the OAAA, continuing to shape charitable giving tax strategies and tax planning. The 7-bracket tax structure was made permanent. The standard deduction now rises to $15,750 for single filers and $31,500 for married couples. So that's why you might see that people aren't necessarily giving, they're not as incentivized to make charitable gifts because of the fact that the standard deduction is higher. There is something that we can touch on later regarding donor advised funds, but anyway, for the record, $15,750 for single filers, $31,500 for married couples. And the 60% AGI limit, the adjusted gross income limit for cash gifts to charities, is also made permanent. You might remember it was 50% not that long ago, then made 60%, and now it's a permanent thing. So that's good. Compare that back to the 30% that I talked about in the prior slide for gifts of appreciated securities or appreciated property held for more than 1 year. Again, twice that for gifts of cash. And also, this is very important and maybe disappointing for those of us in the charitable industry because we're always looking for incentivization. But the federal estate and gift tax exemption increases to $15 million in 2026 for individuals or $30 million per married couple. We were hoping, or some of us were hoping it would go down because then that would trigger people to say, hey, I got to do something with my estate. Maybe I can do something charitably. But that was not the case. All right, moving to the next slide here. All right, dollar threshold updates, just a little bit more. I just wanted to talk about this as well. Keeping the annual gift tax exclusion at $19,000. The OAAA lifts the lifetime estate gift exemption, as I just mentioned, to $15 million in 2026. It replaced forecasts that it would drop to $7 million. Again, that did not happen. So 15 million and 30 million. Cash versus non-cash gifts, as I just said before, the OAAA leaves the 60% AGI limit unchanged. Itemizers will only deduct amounts, again, above, as I mentioned before, 0.5% of AGI. And that QCD limit stayed the same. The non-itemizer deduction may make direct cash donations more attractive to those who don't itemize. Another thing I will mention about the QCD is it is indexed to inflation. Not that long ago, it was $100,000 per person out of IRAs. Then it went up to $105,000 per person. Then it went to $108,000 per person. And indexed to inflation, who knows what it'll be? It's probably going to be something like 110 or so. But anyway, right now it's $108,000 per person. Other OAAA tax changes. The SALT cap, state and local tax cap, deduction cap increases to $40,000 in 2026 and rises 1% annually through 2029 before reverting to $10,000 in 2030. School voucher donation credit. In 2027, donors can claim a credit up to $1,700 per taxpayer for gifts to organizations that fund scholarships for private or religious K-12 schools. And university endowment tax. This is a little different. A tiered tax of 1.4% to 8% is imposed on investment earnings of institutions with more than $2 million in endowment per student. Smaller colleges are exempt, right? Why are we doing that? Or why did the government do that? Because they could, right? Because it's a larger amount of money and because that's been the case as long as I can remember working in the nonprofit world. Excuse me, there's always talk about how to either tax or force money out of endowments. That's always been something that's been very strong. All right, I'll pause here. Maybe take some questions if there are any before we go into donor advised funds, which I will also be alluding a little bit back to the OBBBA as we go. But any questions from the audience, Sharon or Carmen?
Yeah, we have a request to confirm the salt cap increase.
Yep,
Could you confirm
confirm.
the amount for this year and moving forward?
Yes, I apologize. It is for 2025 and 2026. So it was changed for 2025. I'll go back to that slide. $40,000 in 2025 and rises 1% annually through 2029. So it is in effect for this year as well. But reverting back to $10,000 in 2030. Any other questions? Okay, no other questions. We'll keep moving. Donor advised funds. So wanted to end the presentation today with this, which is worth noting because so much money is in donor advised funds. And I just want to give you a little history lesson and then kind of move into some things you may or may not know about DAPs. So the first donor advised funds were created in the 1930s. Though DAFs were not recognized formally in the IRS code until the Pension Protection Act of 2006. So 70 years went by before they were actually recognized. That's less than 20 years ago that they were actually recognized. And yet, as you'll see, they're so significant. In the 1990s, DAFs really began to take off in visibility and popularity and are philanthropy's fastest growing vehicles today. Fastest growing. That's worth accenting. If you're not familiar with them, get familiar with them because they are here to stay and they are like a rocket ship. So it's the most popular way to give at community foundations, generally speaking. When I worked at the New Hampshire Charitable Foundation, it was definitely the most popular way because of all the benefits of a donor advised fund. You get to put money in and potentially get a tax deduction depending on the situation. You get to invest the money and then you make grant recommendations out of it for 501c3s or various ways to help nonprofits in ways that are maybe easier than giving out of your checkbook and also extremely beneficial in the sense of it's it's uh, it's so it's so helpful, especially at the end of the year when you can just put an order in and make a grant recommendation, say for 15 different grants to go out into the community, and then the donor advised fund sponsor will take care of it from there. So I just wanted to give you some figures from the donor advised fund facts and figures. It was 2024's National Philanthropic Trust Report. Again, very soon, if not this week or next week, we will probably see the 2025 National Philanthropic Trust Reports coming right out. But before we go into that, I just want to spend a little time. There is no required minimum annual payout per IRS rules, unlike the 5% of private foundations. So it's kind of strange, right? Think that this is a vehicle that has no required minimum annual payout. That did not change. There was no changes to that, thanks to the good people in Washington who are the advocates and lobbyists on behalf of nonprofits. There was a lot of work done. They're sort of the unsung heroes in many ways, talking to lawmakers and trying to keep certain things at bay. So if you see the OBBBA and you go, well, it's not that exciting, that's actually good news. It means that there are a lot of things that could have gone horribly wrong and definitely affected nonprofits in a pretty bad way. But because these lobbyists are so on top of it and paying attention, they really were doing the good work behind the scenes. So anyway, back to this, no required minimum annual payout continues. And then that requirement of the private foundations do 5%, that still exists. So now here's a thing that you'll start to see through these slides. Donor advised fund sponsors tend to self-regulate to address inactive funds and force out grants. They don't want to be seen as institutions that are hoarding money, or just they're only in it to take the money, grow it, and so on. They have worked really hard. I think a lot of these commercial donor advised funds and more to say we do have policies in place. We are trying to force money out every 3 years or every so often, so that we aren't just sitting on this money. We are helping the people who have these donor advised funds put money out into the community and make the impact that we'd like them to make. Now, grants can only be made, for the most part, they can only be paid to verified 501c3 organizations. And there are some exceptions to that, but generally speaking, that's what the case is. And then there are almost 2 million charitable organizations in the country right now, which might surprise you. So there's a lot of organizations looking forward to receiving grants from donor advised funds. Now, I just wanted to hover on this for a little bit. There's a group called Daffinitive. It's the only searchable database that helps you find information on over 300 DAF sponsors. They have an annual subscription fee, which is not cheap, but if you needed it, it's there. There's also something called DAF Widget, and I'll mention something else too called DAF Pay. DAF Pay and DAF Widget. These are icons that sit on a nonprofit's website and helps make donors. They help donors make grants from their DAFs. The idea is to make it so easy that instead of going for their credit card, which many of them will do, there's been research done that people say, oh, it was too hard to make a grant from my donor advised fund, so I will just take it from my credit card. Well, this is a way to, I think they say within 3 clicks to get to the idea of taking money out of the DAF and making that grant to the nonprofit. So that's good, right? And DAF Pay had something, I think it was October 9th, something like that, where they had a DAF day where they were trying to put a lot of emphasis and encouragement for people to consider making grants from their donor advised funds. But anyway, just consider DAF Widget and DAF Pay as icons that are sitting there trying to help make it easy for people. Now, making pledges, I just wanted to hover on this a little bit too. When you're making a pledge, they kind of call it the don't ask, don't tell. You're not really supposed to make a pledge from your donor advised fund because it's sort of a commitment to paying out over X period of years, usually 5 years or so. That's not really the right of the person who has the donor advised fund to do that, because then it's an obligation. So they call it the don't ask, don't tell, because if you don't say anything and you just make a grant out of it to pay a pledge, if the donor advised fund sponsor doesn't know, then there you have it. But if they do know, it just puts them in an awkward position. So if you're making a pledge from your DAF, I wouldn't necessarily tell the DAF provider that. Now, checkbook giving versus DAF giving, that's the decision people are making. I mentioned earlier, if you're writing 15 checks, that might be more cumbersome than just placing an order for 15 different grants to come out of your donor advised fund to benefit all these different nonprofits. So that's really what it comes down to. There is a myth, I will say, out there that a lot of nonprofits say, oh, if we could just get the list of all those donor advised fund holders, oof, that would really change everything. That would be most amazing. Well, really, if you think about it, those donor advised fund holders, they're probably your donors that you already know about. They're just choosing whether or not to make a check contribution from their checkbook, or they're trying to make a grant from their donor advised fund. But they're not this mysterious group of people over here. They're really the people you're already marketing to. So it depends on whether or not they want to use a DAF. So that's the way I would think about that, is market the best you can, and then people will come forward and give in whatever way is best suited to them. Single issue DAF sponsors versus commercial DAF sponsors versus community foundation DAFs. Those are the 3 major categories according to the National Philanthropic Trust. Single issue DAFs are like where I used to work at Dartmouth College, where we'd have our own donor advised fund. Commercial DAFs are like Fidelity, DAF Giving 360, Vanguard, National Philanthropic Trust, and community foundation DAFs, of course, like here in New Haven. So they have their own community foundation as well, just like 700 to 800 other community foundations across the country. Many of them have their own donor advised funds. As I said, very popular way to give. So now back to the National Philanthropic Trust report. They looked at 1,140 charitable organizations that sponsored donor advised funds. I bet you didn't know that. I didn't know that. I had no idea charitable organizations to the tune of almost 1,200 were sponsors of donor advised funds. I mentioned Daffinitive lists about 300, but there's almost 4 times that out there in donor advised fund sponsors. So 73 national charities, 723 community foundation, and 344 single issue charities. So national charities, again, being, like I mentioned before, Vanguard and so on. Single issue, as I said, Dartmouth, for example, or any sort of specific charity you might think of that has their own homegrown donor advised fund, and then community foundations. So DAF donors, according to this report, once again granted at historic levels. Grants from donor advised funds totaled $54.77 billion in 2023. It's a lot of money. Grant making has more than doubled in the past 5 years from donor advised funds. That's why there's such a force to be reckoned with. Now, here's the thing I mentioned. I alluded to this already. Donor advised fund charitable assets increased to $251 billion in 2023, up from $228 billion in 2022. And so, those dollars continue to increase. And as I said before, though, the industry is aware of that, and they want to be moving that money back out, as you will see. Now, to compare $250 billion to private foundations, the Federal Reserve has data that indicates that the total financial assets were approximately $1.48 trillion in 2023. So roughly six times the amount of what are in donor advised funds. So private foundations still hold the bulk of the assets, but as you'll see, and as you can probably already appreciate, that's going to be challenged. In fact, I'll just tell you as a side note, I went to a conference 2 months ago, and a group called Foundation Source, which were really solely concentrating on private foundations, now is a donor advised fund sponsor, or they actually partnered with a donor advised fund institution. So in other words, they see where the puck is heading. They know that it's not just private foundations that people are choosing, it's also they're choosing donor advised funds. So why not have both? As they say, why not sell sunglasses and umbrellas, right? You'll be ready for all kinds of weather. You'll be ready for whatever people are looking for. So that's what's happening, right? So I just think you're going to see more and more emphasis on how these donor advised fund sponsors are showing up. And again, these figures represent increases. That's another thing to remember. Both private foundations and donor advised funds, the dollars continue to increase from prior years. So here's the thing that you want to hover on right now. Donor advised fund payout rate decreased, not by much, to 23.9% in 2023, down from 24.1%. So call it 24%. So 24% is the payout rate from donor advised funds. You may remember what I said earlier about the fact that they're not required to make any sort of payout. But they do, to the tune of 24%. And private foundations are required to make a 5% payout. So aggregate grant payout rates from DAFs have exceeded 20% in every year on record. So 24% is impressive, but every year on record, donor advised funds have exceeded 20% in their payout with no requirement. They do that on their own with no regulation. The highest payout on record occurred in 2021. It was 28.7%, not surprisingly, coming off of COVID. So the average size of an individual DAF account is estimated to be at about $141,000 for 2023. Average size. This is a 9.2% increase compared with the revised estimate for 2022 of $129,000. Now, according to the same report, National Philanthropic Trust 2024 Donor Advised Fund Report, contributions to DAFs totaled $59 billion, but that did represent a decrease from 2022 of $75 billion. Still pretty impressive in the fact that you have $60 billion going into these. This is an interesting figure. The number of individual DAF accounts rose by 2.6%, up from 1.9 million or so to almost an even 2 million in 2023. I remember not that long ago where they reached 1 million individual accounts. So it wasn't that long ago it was 1 million, now it's 2 million. And I'm sure you'll see that number continue to increase. So these figures increase, as just to state the facts here, indicate a decline in contributions, but a continued increase in the number of DAF accounts. So more and more people are getting donor advised funds, even though in the aggregate, the decline in contributions was there. Now, just a few other things to mention. Thresholds for help. when we think about community foundations, for example, here in Greater New Haven, you get help pretty much at every level. Like anybody who sets up a donor advised fund, you're probably going to get some guidance from the community foundation. That's what you're signing up for. But not everywhere will you get help, which means a lot of these donor advised funds can be set up by people who are very self-directed. So the thresholds for help at Fidelity, for example, it's a $3 million threshold, which means at $3 million, you will get someone assigned to you to help you figure out how to grant money out, what to consider, basically kind of like having your own philanthropic advisor. But that's not something most people can do. They can't necessarily hit $3 million. I think you can set up a donor advised fund at $1 at Fidelity, but only at 3 million will you be able to get help. So that's why people tend to go toward community foundations, because they're saying, well, they're going to help me no matter what the threshold is to set up a donor advised fund. I'm going to be able to have somebody help me out. Now, bunching and bundling, I alluded to that before. I'm going to mention it here. So we talked about how we've got these standard deductions for single individuals and married couples. We talked about $15,000 or $31,000. So if you are trying to put money into a donor advised fund, if you say you were giving at a level of, say, $13,000 per year in your single, or you're giving at the level of, say, $29,000 in your married couple, you're not, to state the obvious, crossing that standard deduction threshold. So bunching and bundling is saying, what if we stacked a lot of money into that? We put $60,000 in a given year. Basically, maybe instead of giving every single year at that level, I said like 29,000 or so, we're giving a lot. We're giving 2 or 3 years worth of contributions, for example, in 1 year. So we beat the standard deduction, and then we get all that additional deduction for everything over and above the standard deduction. So that's what bunching and bundling is. You're bunching your contributions together, you're bundling them together, and maybe you take a year or two off. You don't contribute to the donor advised fund. You take a rest, and then you build up, and then 2 or 3 years later, you do it again. You put $100,000 in there, whatever the case may be. So now you're really trying to maximize your deduction in that particular year. Again, instead of just being slightly under that threshold and never really gaining the benefit of that extra deduction. So as I mentioned, no required annual payout versus a private foundation required 5% payout each year. But I wanted to say this, the average payout on private foundations with that 5% mandatory payout level is actually only 6%. So the argument there is when you give people a low threshold, they'll take it. They'll say, well, I have to make a distribution from my private foundation this year, and it has to be 5%, so that's what we'll do. Versus with donor advised funds, ironically, without any specific amount, they still shoot for over 20%. So I just thought that was kind of ironic that you would have this regulation and they play to the regulated amount versus no regulation, and they give about 3 to 4 times higher than that. Anonymity, something also to talk about donor advised funds. People will say private foundations are anything but private because you have a 990 that's filed, and people don't necessarily know that they do know what you've done. They can see what grants you've made, for example. With donor advised funds, you can be anonymous both personally. So you can say, like, people don't know who I am. And maybe I can even make the fund anonymous. I can call it the Green Tree Fund or something that's very vague. And that way people wouldn't necessarily know who I am there. I mentioned that because I did meet a gentleman at Dartmouth College who gave me an appreciation for anonymity. I think everyone probably has their own perceptions of why people are anonymous. In his situation, he said that he would receive about 100 phone calls per day from different charities who are trying to solicit him. So to protect himself, he said, we just have to give anonymously. We just can't let people know what we're doing. They just seem to kind of come after us. So we still want to be charitable, but we just don't want people to necessarily know who we are. And if we choose to reveal ourselves, so be it. But on a general basis, we're not revealing ourselves. So back to the OBBBA implications for DAFs. Gifts to DAFs do not qualify for the new non-itemizer deduction. I mentioned that earlier. I wanted to just say that one more time. and use a mix of cash and appreciated securities. There you have that 60%, up to 60% of AGI, appreciated securities up to 30% of AGI. So you could do that. You don't want to rule out appreciated securities because you're not getting as high a deduction, because many people have a lot of money in appreciated securities and other types of non-cash assets, but they don't necessarily have as much in cash. So you want to be able to take the best of both worlds, cash and appreciated securities if you have them, and maybe there's a combination effect there. So key takeaways of the impact of HR1, the OBBBA. Make 2025 your giving deadline. So again, you have 6 weeks from today, roughly. Pending caps and floors mean high income donors may benefit by making large gifts before 2026. So basically if you are their advisor, sit down and have a chat with them. If you're a coordinator, then you can bring all the key players to the table, the CPA, the wealth advisor, the trust and estates attorney, and see what kinds of things can be done. Using bunching and donor advised funds, bunching and bundling and donor advised funds to group several years' donations into 1 year. That clears the new 0.5% AGI floor while retaining flexibility. And then, as I said, there is still that 35% cap that you will see in the new year. So being aware of that. And as I said, just in that prior slide, mixing cash and appreciated assets to maximize tax efficiency under the 60% cash, 30% appreciated security AGI limits. And as I just mentioned, consult that tax advisor, that professional advisor, to tailor these strategies to your situation. Every situation is different. People have a whole combination of things regarding assets and giving vehicles and you name it, right? And hopefully so many people, we know this to be true, so many people are charitably inclined, and so they're just looking for direction and somebody to go to help them figure out what that strategy looks like. So to review, part one, it was the impacts on charitable giving due to the 2024 election in the form of the executive orders. Part two, we hovered on gift tax exclusion, cash and non-cash gift deductibility, annual gift exclusions, and the qualified charitable distributions, the QCDs, and the OBBBA updates. And part three, donor advised funds. All the 2023 trends and numbers, and the fact that we should be thinking about these things and trying to work with them because they are such a growing and powerful way to give. And with that, I will take questions, and I'll stop sharing my screen and just see if people have anything they'd like to ask questions about, bring up. We have about 12 minutes together.
Thank you, Rick. I think you've shared an awful lot of great information, and we do have questions, and they're centered around retirement contributions and qualified charitable distributions. So one question, it involves a married couple. So if a single person, I'm sorry, if one member of a married couple uses the maximum qualified charitable deduction of $108,000, how does that work with their return if they file jointly, or can they only file singly? And I should preface that by saying neither one of us is a tax accountant.
Right, that's true. So let's just be clear. The QCD per person limit, as it was said, 108,000 per person. So it can be up to $216,000 per married couple, each one maximizing their $108,000 from their respective IRAs. Okay, so does this mean the investment can be in one name and applied to the joint filing? Again, I would say you can do 108,000 for one person, 108,000 for another, up to 216,000 for a married couple. So I don't know if that answers the question. It's just, you don't have to tie it to one name. It's a joint filing, and then it's just a matter of how much are you saying. The other thing to be clear about is, remember, this does not affect your income. It does not touch your income. It goes directly from your IRA over to charity. And because of that, it is not going to be something you can deduct. It is just something you're going to be basically naming that you did it And one thing I didn't really talk about today is required minimum distributions. So at age 70 and a half, you can take up to $108,000 per person. At 73, you have to take required minimum distributions from your retirement accounts. And many people will say, well, I don't want to. So if I can take up to 108,000 per person, I will do that instead of taking my required minimum distribution and paying taxes on it. I'll just send that over to the charity in the form of a QCD, and then I won't have to worry about it. So that's a very popular way to sort of avoid taking an RMD if you're charitably inclined. So that I did not mention that in the presentation, but it is worth mentioning.
Yeah, so that dovetails, nice segue into another question we have is if you're weighing your options about using your required minimum distribution to make charitable contributions instead of using cash, like what's the calculus there? What would you recommend people think about in addition to talking to their professional advisor?
Instead of taking the cash, I mean, again, your CPA, I would say this, your CPA is going to weigh all the options with you, right? Say, what would it be like to do a QCD instead of a required minimum distribution? What would it look like if I just gave cash? And so on. And it's just so it's your kind of, that's what the CPA is for. That's what your accountant's for. They're going to say this, this, and this. Maybe it's a combination of a few things, but at least they'll be able to say to you personally, this is what it would look like for you. Again, how much cash are we talking about? How much are we, do you have the cash? That's the other thing, right? Maybe you don't have enough cash. You don't have $108,000 in cash. So there's a lot of extenuating circumstances that you want to be weighing in on. But at the end of the day, that's what the accountant's for. Let's weigh this scenario A, scenario B, scenario C, and see what's best for you.
Yeah, thank you. Yeah, there's a lot of questions about this. So we know that in the field, we're tracking a bill that would allow required minimum distribution, qualified charitable distributions to donor advised funds. But currently, that's not the case. Can you walk through that because we are getting a few questions on it?
Yeah, I mean, what can I say? Just that wasn't something that came through. I think going back to the lobbyists, they were probably fighting a lot of other battles in the meantime, and then they just that didn't happen. That just wasn't something they could make happen, was to put a QCD into a donor advised fund. And so, but at the same time, we already saw that contributions to donor advised funds are continuing to be strong, and there's a lot of money that are going out of them. So my understanding with tax law at this point is that they fought that battle pretty hard. All the work that went into the OBBA, and they're not going to go back to taxes for a while. So what you see is probably going to be there as you know it, as you've seen it for quite a while, until maybe at some point lawmakers want to go back and go back and address these things again. But this was a big deal, and all the things you saw here are the result of a lot of deliberations, a lot of discussions. So
Yeah, thank you. I hope that we've covered that area. If not, please give us some feedback in the Q&A section and we'll have another stab at it. We also have a question, Rick, about kind of the relationship between the increased salt cap and are we expecting more people to itemize as a result with the restriction, what it was formerly, now what it is?
maybe, I mean, that's the idea, right? There might be some more, you might see some incentivization on that, but who knows, right? I think this is the thing that's interesting about when people are making changes, or tax law changes. It's then you try to follow and see if people have actually done it, and did they follow, basically the bouncing ball? Did they do it? And if they didn't, then the incentivization wasn't that great. So that's the best way I can describe it, is we'll wait and see what happens. But in theory, it would be that more people are doing that and getting some nice tax benefits out of it. But we'll see. It also reverts back in 2030 to $10,000. So it's only a limited time offer, so to speak. So again, we'll see if people take advantage of that. And maybe that's part of the reason they make it revert back, is they just want to see how many people take advantage of it when it's in play.
Right, right. And one last thing I just want to, excuse me, point out. You had mentioned when you covered that the required minimum distributions, the qualified charitable distribution piece, there's a prohibition on sending those to donor advised funds. So I'm not sure how other foundations, community foundations are doing it, but we have created a way for the donor to specify their wishes in advance. They don't continually advise a fund, and it's directed to the charitable entities as they see fit. So we do have an answer for that for some folks at work. So I wanted to put that out there.
Yeah. I think, and maybe this, I see the last question here is, what is the top line takeaway to communicate to our donors? I would say the top line takeaway is lots of changes have been made. It's been an interesting year in 2025. Go talk to your tax advisor, go talk to your wealth advisor, go talk to your trust and estates attorney, and maybe if you can, get them all together at the same time and just say, here's what I'd like to do. How can you help me do my best work? How can you help me get the best tax benefit, use the right assets, use the right charitable giving vehicles? How can you help me do that? So the takeaway is go have a conversation. That's what the donors should be doing, rather than just sitting there and doing things the way they've always done them and losing the opportunity for some sort of a benefit, and or just doing things in silos. You know, I just talked to this advisor, but I didn't talk to this other one. Maybe you want to have a conversation where you have all three of them together on a Zoom call for an hour or a half an hour and just bring the problem set to the table and just see what they do with it.
Yeah. In an ideal world, in the next 6 weeks.
Yeah, I know it's not ideal
can
to do this
happen.
now. Yeah, well, I mean, I'd say, you know, first part of December, it's not unrealistic. Thanksgiving's tough. The end of December's tough. But first 2 weeks, yeah, I think you could
Yeah.
probably get your advisors on the phone or through a Zoom call or in person and be able to hash these things out. It sets a good example of what collaboration looks like as well.
True, true. Well, Rick, I want to thank you very much for sharing your knowledge and expertise with us and going through all these various items in the three areas. I appreciate you taking the time to be with us today, and I thank you. I believe we will have a survey coming out, so we will be sending that out, and we will also send a recap. And Rick has graciously agreed to allow us to share a recording and his slides. So folks will have access to all that information.
That's right. I'm here as you need me. The PowerPoint's there as you need it. And again, go talk to those advisors and make some charitable giving happen, right? Make it happen.
Yeah, exactly, exactly. Thanks again, Rick, and thank you all for joining us.
Thank you very much.